Good evening, everyone, and welcome to tonight's South Market Close. Let's South start with Wall Street. The three major indexes finished flat, with the Nasdaq at 24,876.91, the S&P 500 at 7,428.78, and the Dow at 52,747.32. But pre-market futures showed divergence. Nasdaq futures edged up 0.22% to 27,880.25, S&P futures dipped 0.05% to 7,456.75, and Dow futures fell 0.72% to 52,522.00, suggesting pressure is concentrating on traditional sectors. In individual stocks, Nvidia slipped 0.31% to $197.01, while QQQ and SPY both declined. The Bitcoin ETF edged down 0.03%. On the macro front, the VIX fear gauge rose to 18.74, up nearly 3%. The 10-year Treasury yield climbed to 4.63%. Brent crude surged 3.18%, approaching $90 a barrel. Spot gold gained over 1% to $4,074.80. The dollar index edged up 0.18%. Overall, we are seeing a pattern of strong commodities and weak tech, with both and inflation trades coexisting. Looking at the global macro environment. The 10-year yield has risen for 3 straight sessions. The oil price surge is pushing up inflation expectations, and the market is pricing in a higher probability that the Fed will keep rates elevated. The liquidity tightening signal is clear. The VIX, while still within the normal 15 to 25 range, rose nearly 3% intraday, indicating that the market is pricing in higher potential risks. The dollar index is oscillating around 101.4, slightly stronger. Weak Eurozone data and a stronger yen are factors. For emerging markets, a slightly stronger dollar combined with higher treasury yields will suppress capital inflows, but the relative stability of the renminbi limits the impact. WTI crude surged 3.31% overnight, breaking through the key $84 resistance level. This was driven by a sharp drop in U.S. crude inventories and rumors of OPEC production cuts. This is the clearest macro signal right now. Spot gold rose despite pressure from higher yields and a stronger dollar, suggesting that geopolitical risks and concerns about tech decoupling are providing additional demand for gold. The current global market is in a state of structural risk-off. The energy rally is supply-driven, not demand-driven. The tech sector is under pressure from escalating U.S.-China restrictions. Rising interest rates are compressing growth stock valuations. Capital is rotating out of high-valuation growth stocks and into inflation trades like energy and commodities, as well as safe haven assets like gold. Turning to the renminbi. The onshore and offshore rates are both around 6.76, showing two-way fluctuation but overall stability. The central bank is maintaining effective control over the exchange rate band, with no one-way depreciation pressure. The renminbi's stability is an anchor for foreign capital, but the rise in U.S. Treasury yields will limit large-scale net buying by northbound funds. On the U.S.-China front, reports suggest that Treasury Secretary Bessent's visit to China may be delayed or cancelled, which means the easing expectations are fading. Sectors that benefited from that expectation may face profit-taking. The Biden administration is expected to announce new tariff investigation results on Chinese chips this week. The Netherlands is tightening export controls on lithography machines. The U.S. Defense Authorization Act includes multiple provisions restricting tech investment in China. These headlines will likely weigh on opening sentiment for shares today. We expect a flat to lower open. For shares specifically, the Shanghai index rose yesterday but will struggle to form an effective uptrend under current external and macro pressure. The Chi-Next board rose more sharply yesterday but faces profit-taking today due to chip tariff and geopolitical risks. In terms of sectors, energy and petrochemicals have the strongest logic. Crude oil breaking above $84 directly catalyses oil and gas and oil service stocks. These sectors have low valuations and high dividends, making them attractive in a defensive environment. Utilities and power stocks also show defensive characteristics. The data center power bottleneck theme continues, and higher energy prices raise power cost expectations, benefiting thermal, hydro, and smart grid stocks. On the risk side, the tech sector, especially semiconductors and optical modules, faces multiple negative factors. The short-term risk-reward ratio is poor, and chasing highs should be avoided. Consumer discretionary and shipping sectors that previously benefited from US-China easing expectations also face correction pressure. Northbound funds are likely to see net outflows or small net inflows today. Our core judgment for today is that inflation shock is compressing tech valuations, risk aversion dominates the market, and the focus should be on energy and defensive sectors. Our probability assessment is 30% for an up day, 50% for a sideways day, and 20% for a down day. Thank you for watching, and we will see you tomorrow.